Accounting is often linked to a fast tree with deep roots, having grown and branched out over many years into various disciplines. Among these branches, we find financial accounting, managerial accounting, taxation, auditing, and bookkeeping. However, when people commonly refer to accounting, they usually mean financial accounting. So, what exactly is financial accounting? Financial accounting is the systematic process of identifying, recording, summarizing, and analyzing entities' financial transactions. These transactions are then present in the form of financial statement. Hi, I'm Evan, and if this definition seems a bit complex, don't worry, stick with me for the next 10 minutes or so, and I'll break down how financial accounting functions step by step. I recommend watching this video through to the end, and at least once it grasps the bigger picture. Let's dive in. Let's imagine you own Ruff Times, a tabloid newspaper that's covered all the latest story about our favorite friends. In March, you ran a special promotion for annual subscription starting on the 1st April. The response is overwhelming with $40,000 in new subscription paid in cash. The initial step in financial accounting is to identify the transaction. In this case, the straightforward. You earning $40,000 for new annual subscription, which common on April and continue to March 23. So what's next? It's time to create a journal entry. A journal serves as a record of financial transaction and appear as follows. It includes the unique journal number, date, description, effective, count, and subscription. Debit and credit both amounting to $40,000. Ruff Times employ double entry accounting, where each transaction affects at least two accounts, and the total debits always equal the total credits. Fundamental accounting equation. Assets equal liability plus equity. That's a business owned resources are equal to its obligation plus the owner claim on the business's net assets. Double entry accounting ensures this equation is always balanced. Debit and credit represent the two sides of every transaction. Credit denotes the source of economic benefits, while the debit indicates where the benefit goes. Today, virtually every major business worthwhile uses double entry accounting, including Ruff Times. In this example, you debit cash by $40,000 to increase assets and credit subscription revenue by $40,000 to record income. In way, if some terms are still unfamiliar, they'll become clear with time. If you want to explore this concept in greater detail, check out my Accounting Basics playlist, link in the description below. Next, you post the journal entry to your general ledger, a comprehensive repository for all financial data. Modern businesses like Ruff Times use accounting software to manage their general ledgers. Posting a journal entry involves categorizing it into appropriate accounts. There are six primary types accounts: assets, liability, equity, revenue, expenses, and withdrawals. In this case, you debit offset your cash account by $40,000 and the right side your subscription revenue account by $40,000 too. When you tally this amount, you have 48 in cash and 75 subscription revenue. In the general ledger, your journal entry for March address the cash collection, but let's fast forward to your fiscal years and on December 31. At this point, you prepare an adjusted trial balance, which summarizes the closing balance of all general ledger accounts. A closing balance represents the cumulative total of all transactions effective and account. Debit are on left and credit are on the right. The trial balance should show equal total debits and credit, ensuring that the accounting equation holds true. This unadjusted trial balance serves as a test, helping you identify any imbalance or errors. However, it's still unjust because it doesn't consider the accrual method of accounting. Under accrual accounting, revenue is recognized as it earned and expenses are recorded as they incurred. But Ruff Times initially used cash accounting, recognizing revenue upon cash receipt. To align with accrual accounting principle, you need to post adjusting entries. These entries bring your books in line with the accrual methods, ensuring a more accurate profit calculation. The adjusting entry in your case reverses $10,000 of subscription revenue, temporarily classifying it as a liability in an account called the year revenue or unearned revenue. This recognizes that you still owe a customer 3 months of Ruff Times subscription to January to March next year. Posting this adjustment to your general ledger and revisiting your adjusted trial balance, you'll need that your subscription revenue decreased by $10,000 liabilities, ensuring the accounting equation remains balanced. With your books now complete with the accrual method, you can process to create financial statements. The statements are reports summarizing your business's financial activities over a specific period. The primary financial statement include the balance sheet, income statement, and cash flow statement. The balance sheet offers a snapshot of your business's assets, liabilities, and equity at a particular moment. Give readers insight into your financial position. The income statement summarizes your revenue and expenses over a decent time frame, providing a view of your financial performance and profitability. Finally, the cash flow statement details cash inflow and outflow during the same period, distinguishing it from profit, which may differ due to the accrual method. Once these financial statements are ready, they can be shared with investors, lenders, and creditors to help your business financial health. Investors will compare your performance against expectations and decide on investments based on your financial statement. After completing your financial statements, you post closing entries to prepare your books for the new year. Closing entries clear out temporary accounts at revenue, expenses, and dividend, ensuring you start refresh in the upcoming year. Together, these steps continue the accounting cycle, embodying the essence of financial accounting, systematically identifying, recording, summarizing, and analyzing financial transactions and report them through financial statements. I want to extend a special thanks to Manas and Food Menu for requesting this topic. Start your journey right here. Thanks for watching and I'll see you in the next video.